Welcome. In this video, we're going to review the stock markets and the transactions that take place within them. We're going to discuss regulations, the nature of trades, and how we identify and measure the markets. So about the objectives, we're going to talk about how do markets work? How do we measure the markets? Are there differences in the different types of brokers that we can hire? What types of different transactions can we use? What are the strategies with those types of transactions? What are the key regulations that impact the trading of securities? And in the end, are our funds secure in a brokerage? So we'll talk about the SIPC. So let's get started. Let's talk about the size of transactions. A round lot is typically 100 shares. So again, imagine buying 100 shares of Tesla versus buying 25 shares. Now, why this is important relates to the cost of doing business. Typically, it costs more to buy an odd lot than a round lot. So again, odd lots are common among retail investors, right? People that just want to buy a few shares of stock, maybe individual investors. And historically, it's been much more expensive, as I mentioned, to buy in round lots than in odd lots than round lots. Now, with the new environment with what looks like zero commissions, this seems to maybe have disappeared. But when brokerage firms are buying shares from other brokerage firms, they always buy them in round lots. What are securities exchanges? They're platforms like the New York Stock Exchange or the NASDAQ, where securities are bought and sold. Some of them are physical places, some of them are computerized networks. They both provide many services, but liquidity for investors and a mechanism for creating prices are the most important. For instance, companies like Microsoft pay fees to list on the NASDAQ because of its focus on tech stocks, providing both prestige and liquidity. So the New York Stock Exchange is a physical building. This is where actual trades occur. It's designated as designated market maker or specialist creates the market. They must always transact when requested. Again, supply and demand create the pricing mechanism that we follow. If you notice here at the very last close, right, it showed here in this day that there were 3,437 issues traded hands. 1,395 went up, 1,889 went down. There were 114 that had reached new highs, and there were 36 that were at new lows. So we can see that this is the kind of activity that goes on inside the New York Stock Exchange. Companies want their stocks on this exchange as it's very prestigious and more buyers at that market, right? So again, roughly there's around 2,800 are listed. However, we know that there are a lot more that are trading there. The NASDAQ is a computerized network. The listing requirements are lower than they are for the New York Stock Exchange. So we will typically maybe find smaller companies, but also the NASDAQ has a tendency to really attract technology companies. So a lot of the tech giants, Meta, Apple, Amazon, they all trade on the NASDAQ as it is a more, again, a less expensive version, if you will, of the marketplace itself. Again, if you see here, 4,500 shares traded, 1387 went up, 2,900 went down. There were 95 at new highs, 129 at new lows. You can see that these markets have a wide range of activity that goes on inside them. An over-the-counter market is an informal market for shares that might not necessarily be listed on an exchange. There are really no dealers or market makers here. There's something called the OTC bulletin board. Sometimes this is referred to as pink sheets. So this is a subscription service that companies apply for, and they brokers, and they run this service for investors. Many of the stocks in this OTC market are priced at less than $1. So they're referred to as penny stocks. What about internationalization of markets? Right? The U.S. investors, you can buy and own different stocks of foreign countries. And there's actually a couple of ways you can do that. One of the ways that's the most popular, one of the most popular ways is through something called an ADR, an American Depository Receipt. Now, these are bought and sold on exchanges just like any other stock, but they are sponsored or they're unsponsored. So sponsored ADRs are created by a foreign company through a bank. And of course, the firm pays any of the fees, etc., for being listed through this bank. Unsponsored ADRs are created by a brokerage firm who thinks that there's a market for the stock. They hire a bank to create the ADRs, and in this case, the fees are paid by the stockholders of the ADRs. So again, Alibaba uses ADRs on the New York Stock Exchange. That allows U.S. investors to own shares without dealing directly in Chinese markets. So why might a person prefer an ADR over buying in a foreign market? Well, the advantage is the currency, right? If you're buying in a foreign market, you need to have the foreign currency in order to run this foreign market exchange. So again, this is just one of the aspects of how you can invest in equities in the marketplace. There's what they refer to as electronic communication networks. These are utilized by large institutional investors. They trade with each other. So again, we know that large orders can impact prices. So these orders avoid exchanges. So they avoid the impact on the supply and demand that the pricing mechanism relies on. So again, they post what they want to buy or sell, and they hope somebody wants to match that. Again, if nobody wants to buy this, then they may ultimately go to the marketplace, or they could try another ECN. So again, major institutional traders like Vanguard or Fidelity, they often use these so that they reduce the impact of their trades on